Hello, this is Hunter Thompson, and this is Group 5, and we're going to be going over Case 12 today. So question 1 asks us that it tells us to develop an operating cash flow forecast for the tanning equipment that we are going to be using. It gives us 3 different cases. Excuse me. Best case, which is like 100% usage. Most likely case, which is 80%. And then we have our worst case at 50%. So looking over at this, we see with each case the hours per month. So obviously the best case is higher. We have 172, 137 for our most likely, and 86 for our worst case. And then down here we see our client service per hour, as well as the possible sessions per month and how much we charge for each session, which is ended up being $3. And we see the percentages like we asked about here: 100%, 80%, and 50% for each case. So we're down to the operating costs, and we have our like use for electricity and the bulbs, which is going to be fixed. It's the same bulbs for each session. So we have those numbers there. And then you have the cost for each bulbs, the hours in the bulbs, as well as how many sessions per set from each bulb. And then that's where we see a difference is the number of sessions per set. So best case, you have about 5,200 for the dome, most likely about 4,200. And then the worst case, you have 2,600. And then that using those numbers, we can get our cost per session. So we see in the best case that our cost per session is going to be the lowest, since we're getting the most use out of these sets of bulbs and electricity. Most likely case, you have 25 cents and 13 cents. And then at the highest, which is the worst case, you have 40 cents for the dome, and 41 and 22 cents for the bed. Then we go to additional revenue that we have. So things like the lotion sales. So those are all going to be the same numbers. It's the same lotion, same bottles. So those aren't going to change with our different rates. And then using those numbers, we can finally get our total revenue per session and our total cost per session. So we see revenue per session is going to be the same for each case, but with total cost per session, we see the best case having lower costs here at $1.20 and 91 cents, $1.25 and 93 cents for the most likely case, and at the highest cost for our worst case, we have $1.41 and just over $1 for the bed. And to continue that, then we can look at our margins. We see here with the best case, we have the highest margin per session. And then going down here to our lowest margins, we obviously want the higher margins. And then we can look at monthly revenues and operating and advertising costs, as well as our EBITDA. Revenues being the highest, obviously, for our best case, and then the lowest for our worst case, with the worst case ending up around 1,300. And then with those numbers, we can look at our monthly depreciation, which is we use the same straight line depreciation and a tax rate of 30%. So we use those and we can get our monthly operating cash flow. So we do revenue minus the cost times 1 minus the tax rate, plus the depreciation with the tax rate. So we see here that our monthly operating cash flows for our best case scenario was just over $1,000 for the domes, close to 800 for the beds. Bigger drop off here, we see our most likely case around 750 and 550, and then the worst case scenario only 300 and 204. And so annual operating cash flow, again, it's going to be a highest for a best case, around over 12,000 for the best case, close to 9,000 for the most likely, and near 4,000 for the worst case. And then you see same thing here. Economic life for years is going to be the same for each case. It's the same bed, so we see no matter what usage we have, we're going to see the same economic life, and same with the initial outlay of 8,300 for each case. In question 2, we want to calculate the accounting, the cash, and the financial break-even sales for the dome unit and the tanning bed. Using some of those numbers like we got from the last one, like revenue per session, we see the same for each one. It's $4. But here we can look at our variable cost per session and find a total variable cost of $1.20 for the dome and 91 cents for the bed. Our annual fixed costs, our advertising costs in Yellow Pages and other print media, we have 6,000 for both, as well as our annual depreciation of 1,660 for the dome and 600 for the bed. So, and then for outlay, like we looked at, we have 8,300 and then 3,000 for the bed. The life, like we looked at, was 8 years and 5 years. Present value annuity factor at 11%, we have 515 and 370. And then the operating cash flows at which NPV would equal zero, we see that $1,612.86, $811.71 for the bed. And so we look at the different break evens here right in the middle. And so for the accounting break even, we have our fixed cost plus our depreciation. And then we divide that by the number we get from subtracting variable costs from our revenues. And so for the dome, we get 2,739. And for the bed, we get 2,134. Then we can get our cash break even, which is our fixed cost. And we divide that by, again, the number we get from revenue minus variable costs. So we see revenue here, and then the variable cost being here. And so the cash break even, we have 2,145 and then 1,940. And then finally, our financial break even, like we see at the bottom here too, we have fixed cost plus operating cash flows when NPV equals zero, like we got this number here. And then we divide that again by revenue minus variable costs. So for the financial break even, we have 2,722 and 2,203. And so for our average, we use obviously the number of days the salon operates during the year, which is 260. And then so using that, we can get our average daily customers or our sessions needed to break even. And so we see here it's 10.468 and then the 8.472 there.
Hello, my name is Carter Haro, and I'm going to be going over questions 3 and 4. Question 3 reads, calculate the net present value, payback period, and the traditional IRR for each tanning option under the various scenarios. What do the decision rules indicate? So we'll start off with the dome unit. It has we do get its estimated life, initial outlay, cost of capital, and annual operating cash flows from the previous questions. We are able to calculate the present value of cash flows from years 1 to 8 by doing the PV equation in Excel and plugging in the numbers above. For the best case, we get 64,130 and 87 cents. For the most likely, we get 46,286 and 58 cents. And for the worst case, we get 19,520 and 16 cents. We are able to calculate the net present value by subtracting the 8,300 from that to get 55,830 and 87 cents for the best case, 37,986 and 58 cents for the most likely, and 11,220 and 16 cents for the worst case. So then we are able to calculate our internal rate of return. We display the initial payment of 8,300 and then each of the cases annual cash flows. We then use the IRR equation to and select from year 0 to 8 to get an IRR of 150% for best case, 108% for most likely, and 43% for worst case. And then a payback period we get by dividing that that initial payment of 8,300 by the annual payment that we'll receive, or that that will be received in the case, to get that payback period, which for best case is 0.67, for most likely is 0.92, and for worst case is 2.19. Then we have the bed unit. We do the same as the other unit. And for the present value of cash flows from years 1 to 5, this one changing because the life is shorter than the other one, we get 34,679 and 70 cents for best case, 24,427 and 23 cents for most likely, and 9,048 and 51 cents for the worst case. We can then subtract that initial outlay to get 31,679.70 for the best case, 21,427.23 for the most likely, and 6,048.51 for the worst case for NPVs for the bed unit. We can then calculate the internal rate of return once again by getting those annual cash flows and the initial payment by using the IRR function in Excel once again to get an IRR of 313% for the best case, 220% for the most likely, and 77% for the worst case. And then a payback period of 0.32 for the best case, 0.45 for the most likely, and 1.23 for the worst case. Seeing all of these, we can conclude that the NPV is higher for the dome unit, but the bed option does have a higher IRR and a shorter payback period. And then question 4 reads, can Jenny evaluate this business project by assuming just a one-time purchase? Why or why not? What other evaluation methods should Jenny use? So the main thing with this one is Jenny should not consider these expenses as one-time expenses due to each option having a different lifetime. The dome has 8 years and then the bed has 5 years. There's not an accurate estimation in that in those NPVs because the life of the unit is different. So to make it more accurate, Jenny can use the replacement chain method since it utilizes the lifetime of each unit when calculating the equivalent annual annuity.
Hello, my name is Brian Sanchez, and I'm going to be presenting question 5. For question 5, it asked, if you decide to use the replacement chain method, how does the calculation and decision change? So to start off this question, we show the traditional NPVs for both the dome and the bed units, as well as the best case, most likely case, and worst case scenarios, which we computed in question 3. With these NPV values, we can use the replacement chain method to get the equivalent annual annuity, which will take into account the life values of each scenario. Both units are utilizing a cost of funds of 11%, and the dome unit having a life of 8 years and the bed unit having a life of 5 years. For the dome, we get an equivalent annual annuity of $10,849 with 11 cents for the best case. For the most likely case, we got $7,381 with 59 cents. And for the worst case, we got $2,108.31. And for the beds, we got for the best case, we got $8,571 with 59 cents. The most likely case was $5,797 with 57 cents. And the worst case was $1,636 with 55 cents for the worst case scenario. And so when taking into account the different unit lives, we see that the dome is the best investment.
Hi, my name is Ty Roush Gomez, and I'm going to be presenting on question number 6. The question is, what are some externalities, side effects, and other relevant issues that could affect the decision on whether to pick the bed or the dome? So some of our bullet points are, while the dome unit does yield a better equivalent annual annuity, Jenny might not have the funds to fund the machine as it costs more than double the cost of the bed unit. The next one is, with Jenny's operating hours being quite short on some days, having the dome that allows for more sessions per hour is extremely practical. Next one is, while the difference is small, if Jenny is environmentally conscious, she might want to choose the bed over the dome as it costs 20 cents less in electricity per session. Although once again, from an environmental standpoint, the dome will also create less waste as it has a longer life in the bed, ultimately needing to be thrown out once its lifetime is over. And the final bullet point is basically just summing up that if Jenny wants to decide to choose quality over quantity or vice versa, and though with all these bullet points, it is citing a bit more towards the dome.
Hello, my name is Luis Medina, and for question 7, it asks, based upon your analysis, which of the two units is too hot to handle? Why? The tanning bed is what we figured out to be labeled as too hot to handle. Despite some of the financial positives it does have, such as faster payback time and a higher IRR. We found out that it is too hot to handle. On the other hand, the dome has many more advantages, especially in the long term. It has a larger expected lifetime, it has a larger NPV, and larger equivalent annual annuity. As we could see, the tanning bed is the superior short-term decision, but if we look into the long term, going ahead and choosing the dome is the better option. Thank you. And that concludes our presentation.